In the last video, we covered all 5 stages of the trade life cycle at a high level. Now we go deeper, one stage at a time. We start at the very beginning. Trade execution. The moment an order leaves a trader's screen and becomes a real transaction. But before we get to the exchange, there's a step most people skip. How does the order even get there? That's where the broker comes in. It starts with an investment decision. A portfolio manager at a mutual fund, say an asset management company in Mumbai or a hedge fund in New York, decides to buy 50,000 shares of Infosys or Apple. That decision gets translated into a trade order. But here's what most people don't realize. The fund manager doesn't go to the stock exchange directly. They can't. Retail investors in India trade through brokers like Zerodha or ICICI Direct. Institutional investors, asset managers, insurance companies, pension funds, work with institutional brokers, also called sell-side brokers. The fund manager sends a trade instruction to their broker through a system called an Order Management System, or OMS. The instruction specifies what security, how many shares, buy or sell, and any constraints on price or timing. That instruction is now in the broker's hands. The broker's job is to get the best possible execution for their client, the asset manager. This is a legal and regulatory obligation, not just a courtesy. In India, SEBI requires brokers to have a best execution policy. In the US, the SEC enforces similar rules under Regulation NMS, i.e., National Market System. When the broker receives the order, they make a series of decisions. Where do I route this order? To NSE or BSE in India? To NYSE, NASDAQ, or an alternative venue in the US? If the order is large, do I break it into smaller pieces to avoid moving the market? For large institutional orders, say a block of 100,000 shares, hitting the open market at once would push the price against the client. So brokers use algorithms, VWAP algorithms, volume weighted average price, break the order into smaller slices and execute throughout the day, targeting the average market price. TWAP algorithms spread execution evenly over time. Implementation shortfall algorithms try to minimize the gap between the decision price and the actual execution price. Some large orders never go to the public exchange at all. They're matched internally. Broker crosses a buy order from one client against a sell order from another. Or they go to a dark pool, a private trading venue where large institutional orders are matched anonymously so the market doesn't see them and move against you. Once the broker decides on the routing strategy, the order goes out, to the exchange, or to wherever it's being routed. The order the broker sends to the exchange can take different forms. A market order says, execute now at the best available price. Speed is the priority, but you accept whatever price the market gives you. A limit order says, execute only if the price is at or better than a specified level. Control is the priority, but you might not get filled if the market doesn't reach your price. There are others, stop orders, iceberg orders that hide the full size, and peg orders that track the midpoint of the bid-ask spread. But market and limit are the foundation every other order type builds on. When the order reaches the exchange, it enters the order book, a live, continuously updated list of all open buy and sell orders ranked by price. The exchange's matching engine does one job: find a counterpart. In India, NSE and BSE both run electronic order books. NSE's NEAT system, National Exchange for Automated Trading, matches orders on strict price-time priority. The best price wins. If 2 orders are at the same price, the one that arrived first gets matched first. NSE handles the majority of equity volumes in India. In the US, NYSE and NASDAQ operate differently. NYSE is a hybrid model. It has a designated market maker, or DMM, who is responsible for maintaining a fair and orderly market in specific stocks. NASDAQ is fully electronic, pure order book, no human market makers on the floor. When the matching engine finds a counterpart and the trade executes, a trade report is generated instantly. That report is the official record of what just happened. Ticker, quantity, price, timestamp, counterparty. Everything else in the life cycle flows from this moment. The moment a trade executes, it gets reported, in real time, to regulators and market participants. In India, trade reporting happens through the exchange itself. NSE and BSE capture every trade, and trade reporting happens natively through the exchange mechanism to the regulators. Exchanges maintain their own surveillance and trade logs, submitting aggregated end-of-day reports or immediate alerts for specific regulatory breaches or margin thresholds. In the U.S., trade reporting in equities goes through FINRA's trade reporting facilities, known as TRFs, for over-the-counter equity transactions. Trades executed directly on an exchange, like the NYSE or NASDAQ, are captured and reported directly by that exchange. Broker-dealers are required to report every trade within 10 seconds of execution, and for many electronic trades, this happens in milliseconds. The reported data feeds into the consolidated tape, a real-time stream of all equity trades across all U.S. venues, which anyone can access. This is what you see when you watch live stock prices on a terminal. For U.S. Treasury securities and corporate bonds, trade reporting goes to FINRA's TRACE system, Trade Reporting and Compliance Engine, where post-trade transparency rules apply. So when a trade executes, whether in Mumbai or New York, the market knows about it almost instantly. Now, where does DTCC fit in at the execution stage? This is a question that comes up a lot. DTCC, the Depository Trust and Clearing Corporation, is primarily a clearing and settlement infrastructure. Its role really begins after execution, in the clearing stage. But DTCC does touch the execution stage in one important way: trade capture and comparison. The moment a U.S. equity trade executes, the execution venue, the exchange or dark pool, aggregates and routes the trade details to the NSCC, the National Securities Clearing Corporation, DTCC's subsidiary. Ticker, quantity, price, and settlement date are the core components matched and verified instantly by the trading exchange's matching engine prior to being bundled for the NSCC. Over 99.9% of U.S. equity trades enter the NSCC's Universal Trade Capture platform as locked-in transactions. This means the exchange or an authorized clearing intermediary has already matched, validated, and bound both sides of the trade at the exact millisecond of execution. Once matched, the trade moves into NSCC's Continuous Net Settlement System, CNS. CNS is NSCC's netting engine. Rather than settling each trade individually, CNS continuously nets a firm's buy and sell positions in the same security across all trades throughout the day. By end of day, each broker has one net position per security, one number to settle, not hundreds of individual trades. So at the post-execution stage, DTCC's UTC engine is in the background, immediately capturing and validating the locked-in trade data. The heavy lifting, margin, netting via CNS, and guaranteed settlement happens subsequently in the clearing stage. We'll cover that in episode 4. In India, this comparison and netting function is performed by NSE Clearing Limited, or Indian Clearing Corporation Limited, for investor trades in currency derivatives, like USD in Agar futures, or interest rate futures on an exchange, with CCIL handling the government securities and derivatives segments. Execution is where the trade is born. The asset manager decides, the broker routes, the exchange matches, the regulators capture, all in milliseconds. Everything that follows, trade capture, confirmation, clearing, settlement, is the process of turning that matched order into a completed final transaction. Next up, Episode 2, Trade Capture. What happens the moment that execution data hits your internal systems? See you there.